Our assessment is that one, just like these charts have just broken out, and these charts don't break out and then sputter. These bases are too clear, too wide. It's not like I'm drawing a little 2 point trend line, subjectively. This is like 4 or 5 points spanning 11 years, and they all did it at once. So it's affirming, affirming, affirming. Something's going on here. Okay.
Yeah,
Now, most of the American public is not participating. We know that.
right.
They're very sub-level in terms of gold participation or monetary metals. That's going to wake up, especially when the stock market turns down in a way that hurts them. And we're not dealing with mortgages now, mom and pop mortgages. Okay. We're dealing with Japanese government bond implosion. Our government bonds in trouble. UK. This is too big. And when that event hits and they finally realize, central banks and the investment public, that, uh-oh, it's different this time. Something's
Yep.
really bad here.
For months now, Michael Oliver has been warning that the monetary metals are no longer trading like sleepy commodities. They're trading like assets that have quietly crossed a structural line in the sand. And nowhere is that more visible than in silver. Long before mainstream analysts began paying attention, Oliver argued that silver's multi-year momentum structures had reached an inelastic stage, a phase where prices don't just rise, they accelerate. Silver has already broken above the boundaries that contained it since 2021, and more importantly, its relative performance against the S&P 500 has turned decisively higher for the first time in a decade. According to Oliver, that relative breakout is the true tell. The metals are not simply moving up, they are outperforming the largest equity bubble in American history. But silver isn't acting alone. Gold is following a similar script, quietly grinding through an 11-year base against the S&P. Oliver's models show that from 2015 onward, gold has matched or beaten the performance of the stock market. And now, it has finally burst through the top of that range. When you see an asset break an 11-year ceiling, especially a ceiling defined by momentum, not price, you are not looking at an ending move. You are witnessing the start of a major structural trend. This breakout, Oliver insists, is not a late cycle blow-off. It is the beginning of a monetary metals bull market that will look nothing like the shallow rallies of the past decade. And the backdrop could not be more fragile. Silver and gold are breaking out at the exact moment when the U.S. economy is showing the same pre-breakdown behavior Oliver identified before the dot-com bust and the 2007 mortgage collapse. Equity volatility is rising under the surface, global bond markets are struggling to absorb new issuance, and U.S. treasuries are flirting with levels that historically trigger systemic stress. What happens when the public wakes up to the fact that the 60-40 portfolio is no longer a safe haven? According to Oliver, the answer is simple. The money has to go somewhere. And his charts say the destination has already been chosen, out of stocks and bonds and into monetary metals. So in this video, we're going to walk through Oliver's most important charts and decode what he believes is the beginning of a multi-year transition, one that will catch most investors off guard. Because as he says, the American public still thinks this is an old gold rally. But the data suggests it's something very different. If you like insightful deep dives like this, don't forget to like this video, subscribe to the channel, and drop your comments and observations in the comments section below. Every feedback counts. We appreciate the support and hope you enjoy the video.
It's a relative performance chart going back to when gold really was collapsing in 2013. It was also collapsing in relative performance to the S&P, and it's reflected on the spread. You were going from 85%, and by late 2015, you dropped just above 50. That's when the price of gold actually ended then. It was $1,050. But you'll notice if you back to that 2015 low, which is like the end of the first drop, just above 50%, you could draw a line sideways from there if you wanted to. And for the last decade, gold has been either side of that level. Well, what does that mean? It means gold has been performing just as well as the S&P for the past decade. Okay. Either, if it's around 50%, then that's where it was in 2015, meaning it's held its value versus S&P. It's been weaker than that, and it's been stronger than that. Now, during that 11, actually go back to 2014 here, where that green line commences. You could draw a line across 1, 2, 3, 4, maybe 5 highs there, and we punched out above it at the close of last month. Okay, so what? Okay, What it says is gold is no longer going to go mealy mouthed sideways versus the S&P, meaning just as good. It's blowing out of the 11-year wide base. Now,
That's exciting. Go ahead.
yeah, if I dropped this chart in front of you and didn't have a label on it and just said this is stock ABC, what would you say? You'd say, "Hey, I got to buy that guy. He's
Yeah,
been."
it just broke out.
Yeah, okay, that means it just began. Okay, this is what just began. Everybody's thinking about gold is so old, it's overbought, silver, et cetera, et cetera. It just began, folks. The relative asset class shift out of the paper US stock market bubble has only just begun to move heartily into gold. Yeah, since 2024, that last low, gold's been advancing nicely, but within that basing range. So this is a new game. That's what it tells you. It says, wake up. This is not an old trend in gold. This is brand new. The money flow is just beginning. Whenever the stock market has had a bear over the last 25, 30 years, going back 50 years, in fact, remember the 73, 74 bear in the stock market was a huge collapse. During that same time, gold was going from 30 bucks to 200. Okay. So, opposites. Then you go to the dot-com top to the 2002 low. 82% collapse in NASDAQ, 150% in the S&P, yet gold was rising during that time. In fact, kept going for another till 2011. Then the 2007 top, mortgage top for the stock market. Didn't really pick up steam till 8, but between 2007 and 2009, the S&P got cut in half. And gold was rising. Yeah, there were jiggles in there, big ones sometimes, but basically in a major uptrend. So the money goes somewhere when it leaves the stock market. And where does it go? Well, we all know, well, it was either Chase or one of the big banks anyway, Morgan Stanley maybe, made a statement about the 60-40 rule. 60% stocks, 40% T-bonds. Okay. That's the good, stable portfolio. Okay. Well, admittedly, during the 2000, 2002 bear in the stock market, 2007 and 9, if you own T-bonds, they went up. Yields went down. Okay. So it
Right.
was an alternative to some extent. Gold was a better alternative, but T-bonds and gold were competing as places to be other than the stock market. Now that ain't the case, guys. You got the T-bonds right now starting to break some things that if you drop about another 4 points in T-bond futures, right now they're 115 and a half. You get down to about 111 and a half, you're going to have a panic in the government T-bond market that even the Fed is going to have to step into. And they've already hinted they might be doing that soon, buying T-bonds. That's not an alternative. So if you're getting out of the stock market, like one of the big banks just said, hey, it's better now to have a 60-20-20. Okay. Now, my argument would be, how about 60% gold, 20? Anyway, but it's at least it's a realization on the
Yes.
part of big bank, part of the Fed system, that, has gold really, I guess we got to admit, otherwise we look like fools. Uh, this chart says, watch out. It's going to
Yeah.
dominate the when the flow comes out of the paper bubble, it's going to go here because T-bonds aren't acting well, and it looks like they're going to cause some pain and maybe even some headlines for the stock market. The top chart's XAU index, which has been around since the 1980s, gold and silver miners, okay, Philadelphia index. So it reflects the miners, and you'll notice going back to 2014 or so, well, you had a downtrend line, you hit one, two, three, four times, including back, several months ago, you hit it and backed off, and then you blew through it last month.
Yeah.
Okay. Well, again, here now it's echoing what gold says. Gold's beating the S&P, just broke out of a massive base. The miners say, "Hey, me too." Okay. Now, and then one below that is silver.
Yeah. Let's talk about silver. It's been just ripping here. Yeah.
This is
Talk about
last
that.
month's close now. We're higher than that now, by the way. Okay, but S&P versus silver, silver versus S&P, again in the bear trend from 2011 to 15, silver went down, relative performance went down. But as you can see, either side of about what is that level? 6.5, 6/10 of a percent. Uh, Price of silver expressed as a percent of the S&P. It went sideways basically since 2018, really.
Right.
Yeah,
Yeah.
it's a downtrend structure though. And when you broke through that last month, big time, um, and you're further up now, it says the same thing gold says versus S&P. Okay, so it's a chorus. It's not just gold, it's the gold silver miners. It's silver all saying, hey, thumbs down on the stock market. And it's just broken out. You don't break out like this and have a 3 month rally.
Yeah.
This is something that involves years, a couple of years at least. So the asset shift the earthquake has occurred, guys, but nobody's noticing it. All they're noticing is what RSI says on a weekly.
What makes Oliver's assessment so compelling is the confirmation across the entire monetary metals complex. Gold has broken out relative to the stock market. Silver has broken out relative to the stock market. Mining equities, one of the most sensitive barometers of future metal performance, have broken out of decade-long downtrends. These are not quick bursts fueled by sentiment. These are slow-building structural shifts that typically precede the largest multi-year bull markets in precious metals. When the S&P rolls over, history shows the money doesn't evaporate. It migrates. In 1973, in 2000, in 2008, whenever equities reached major cyclical peaks, capital fled toward hard assets. And today, with U.S. Treasuries no longer offering the stability they once did, gold and silver may be the only viable alternatives standing at the intersection of liquidity, safety, and upside. And for everyday investors, this is the key insight. The rotations that define an era never begin with headlines. They begin with charts that look dull, uninteresting, or even overbought to the public. By the time the crowd sees what's happening, the early stage of the move is already gone. What Oliver argues here is that the early stage, the foundation of a much larger capital migration, has just begun. This is not the end of a metals rally. It's the opening chapter of a shift that could redefine global asset allocation for years. Let's get back to Michael O'Iver's interview.
Our assessment is that one, just like these charts have just broken out, and these charts don't break out and then sputter. These bases are too clear, too wide. It's not like I'm drawing a little 2-point trend line, subjectively. This is like 4 or 5 points spanning 11 years. And they all did it at once. So it's affirming. Something's going on here. Okay.
Yeah.
Now, most of the American public is not participating. We know that.
Right.
They're very sub-level in terms of gold participation or monetary metals. That's going to wake up, especially when the stock market turns down in a way that hurts them. They notice. We argue technically that the stock market has been in a topping process since late last year, early this year. At that point, early this year, for example, S&P was just below 6,200. Okay. So you drop, we got about 10% out above that high recently, and we're just sputtering up here for 3 months now, spinning wheels. Our work on the S&P says this is virtually similar or the same as the 2000 dot-com, 2007 top. It was complex. It didn't just occur and then collapse. It was laborious. And in fact, each time they teased you with a new high after MSA declared, get out of this market. Several months later, in both cases, it went up and made a new high, just enough so CNBC could report a new high. And you could hear the cheering. It was a trap. Okay. Also, they're expecting what right now? Oh, the Fed's going to cut. Heck,
Right.
maybe they'll surprise us and give us a 0.5 point. Oh boy. Every time the Fed has started cutting in a series in a serious way, that marked the end of the bull market. In fact,
Right.
yeah, 2001, they started cutting in January. It was a handful of months off the high, not much price drop. They started cutting constantly. Market imploded. 2007, they printed the top tick almost.
Right.
Mid-September 7, they peaked like 3 weeks later in October, and that was it. Okay, so anybody cheering Fed rate cuts hasn't done their homework. It's not what you want because it says something. Anyway, but that's fuel for the monetary metals. They're
Yep.
going to pedal to the floor, So anyway, all these pieces fit together. And that last one I mentioned, the T-bond thing. The T-bonds, something's wrong there. We all know fundamentally, Jamie Dimon said you just can't keep doing this every decade type process where the government debt to GDP and all this. It can't just keep it pushed off. And he said, this time's probably going to be different. Well, I think it will be. And in fact, watch the T-bonds because they've been comatose for about 3 years now. And right now at 115.5, they're sort of in the lower quadrant of the price level the last 3 years. So in other words, very anemic, yields very high. Fed rate cuts don't affect them. Watch out that beast because he drops another 3 points or so below where you're trading right now.
Yeah.
The March contract T-bond futures. you could get a rapid flush, meaning
Yep.
sharp spike. That's going to panic people because nobody expected it.
Yep.
And also it eliminates that quote alternative. Now you're
Yep.
down to one. So what I'm arguing here, wet bar of soap time. There's
Yep.
only one thing that's wet. Okay. And I think it's beginning, and I think these spreads know it. And that's what they're
Yeah.
doing. Yeah, well, the head of the president of the New York Fed, Williams, I think it was about 3 weeks ago, made a statement or a press conference, and I'm sure it was approved from higher ups in the Fed. Uh, the Federal Reserve is going to probably need to start buying T-bonds, he said, or buying bonds, quote
Think about
unquote.
that.
And but not because they're in trouble. He didn't say that, of course, naturally. He said because of illiquidity. Oh, isn't that
Right.
nice? I'm so glad they're taking care. They're nervous. They're nervous as heck about government debt market. And we're not dealing with mortgages now, mom and pop mortgages. Okay. We're dealing with Japanese government bond implosion. Our government bonds in trouble. UK. This is too big. And when that event hits and they finally realize, central banks and the investment public, that, uh-oh, it's different this time. Something's
Yep.
really bad here. That market's bigger than the US stock market, US T-bonds.
Yep.
So you can't ignore it. Watch it.
Commodities are ripping here, and you show some charts. Talk about that.
Yeah, top chart goes back to 2007. It's the Bloomberg Commodity Index, which is a well-balanced index of commodities, energy related, base metal mining, sugar, cocoa, not sugar, cotton, grains, a very broad metric of commodity complex. In 2008, it peaked at 237. Top left chart, that's a price chart, okay?
Right here.
Collapsed down to 100, then rebounded in 2011 when gold peaked and reached up to 170 something. Yeah.
Yep.
But look where it dropped to since. That last red circle is in 2020. That's when gold had doubled between its low in 2015 and 2020. It
This
had
is a
gone,
great chart. Go
yeah,
ahead.
but Bloomberg went down. Okay, so it wasn't correlated to the gold. Then we had the explosive upside. The
Yep.
MSA called at a price of about 70. We said you could probably go up to about 140, and that's where you peaked. Why? There's a channel top we projected there. Sure enough, that channel top worked. Look where we are now. Now, this is as of early this week. We're already higher than that. We're pushing toward that line, that red channel top. What
Mhm.
is that channel? We take the three lowest monthly price closes going back to 2009, I guess it was, or 2000, yeah,
Yeah.
2000, yeah, 2008, and line them up, and there's a nice perfect line through three low closes. It's the same angle of descent we plot through the high monthly close that occurred in 2011 and project it down. And sure enough, that rally was up into thin air, but that line, when we projected it, said, hey, that's a good place to reflex at.
Mhm.
But it's a theoretical channel top. It reflexed.
Yeah.
Happy. That means that channel is valid. You close a month out anywhere near 120. Right now, Bloomberg's 112 as we speak. You're going to break through that price channel that goes back, 2008. Okay. Now, here's annual momentum below. This is
Right here.
measuring the monthly action versus his 3-year average. You had the burst, the breakout that occurred before the price surge. You went off the page to the upside. In other words, it says, hey, I'm out of here. Damn it. I shouldn't have been here. Okay. And even then, it got to 140 in price, which is still like 100 points short of the 2008 high. Okay. After that peak in March of 2022, weeks after the war began in Ukraine with Russia, commodities peaked 3 weeks after that war started, and the momentum dropped back down. And for the last couple of years, it's lived just below the zero line, a little red horizontal on that bottom chart, or below the 3-year average. Yeah. We
Yep.
broke out of that in October at just above 106. Now we're up to
Yep.
112. Okay.
Right
That
there.
that is a statement by momentum that, hey, I'm out of this base. I'm through with my correction. I'm headed for my next wave up.
Hmm.
And
Yep.
we only, and I think there's a multi-wave process here over a span of years.
Hmm.
Commodities are vastly underpriced as an asset compared to anything, compared to their own highs,
Yep.
compared to the S&P. This is a place secondary to monetary metals, but this is a place for investors to look hard at stock-related positions in the commodity asset arena, energy-related, base metals, grain-related, fertilizer, all those. Throw darts at them. they are look poised to be a place to be on the upside, while the stock market in general goes down.
Oliver's final warning brings every piece of this puzzle together. The broad American public is still asleep, still underexposed to monetary metals, and still assuming that the stock market's slow grinding highs reflect strength rather than exhaustion. But behind the scenes, momentum structures are already rolling over, just as they did in 2000 and 2007. Those peaks did not crash immediately. They stalled, they teased new highs, and they lulled investors into believing the bull market was intact. By the time the downturn became obvious, the rotation into gold was already well underway. Oliver sees the same pattern today, but with one critical difference. This time, the bond market, the traditional safe haven, is flashing its own warning signs. That is the scenario that amplifies the power of the metals breakout. If equities enter a prolonged topping phase and bonds fail to provide shelter, capital has only a handful of viable destinations. This is why gold's 11-year breakout matters. This is why silver's relative surge matters. This is why the mining index's punching through decade-old resistance matters. These are not isolated events. They are signals that the global financial system is entering another reallocation cycle. So as Oliver points out, the real story isn't what market commentators are debating today, whether the Fed cuts by 25 basis points, whether the S&P makes another marginal new high, or whether weekly oscillators show overbought conditions. The real story is the quiet shift underway in long-term momentum, charts breaking out from structures that have taken a decade to build, correlations reversing at major turning points, and a bond market that can no longer mask growing sovereign fragility. When these elements align, they tend to produce multi-year moves, not 3-month rallies. For investors watching from the sidelines, this is the moment to think strategically. The early stages of a generational transition rarely feel dramatic. They feel uncertain, confused, and easy to dismiss. But as Oliver's work has repeatedly shown, the market speaks long before the headlines do. And right now, the message is clear. The era of effortless equity gains and reliable bond hedging is fading. A new cycle is emerging, one in which monetary metals regain the central role they have held through every major financial unwind in modern history. If you want to stay ahead of this transition, not chase it after the fact, make sure you're subscribed, turn on notifications, and share this video with someone who needs to understand what's happening beneath the surface of today's markets. Your support helps this channel keep delivering clear, honest analysis during one of the most important financial turning points of our lifetime. Thanks for watching.